Hi, everyone. It's John Pocaroba. We're at the Boston meetup tonight, and we're going to talk about the general market. This presentation is made by Rain King LLC for educational purposes. I'm an amateur investor. I'm not associated with IBD or MarketSmith, but you will see the trademarks and some of the charts coming from IBD and MarketSmith charts. So the agenda for this general market update is I'm going to talk really quickly about the big picture, but then we're going to talk a little bit about market sentiment, some of the internals of the market currently, and probably one of the biggest questions out there is this a bull market correction that we're going through, or are we headed towards a bear market? And then we'll talk about some early signs I see and some next steps. So the big picture overview is, those who follow me, this chart probably gets really old, but it just sets the big picture. You know, really believe in this super cycle. It started a major bull market in 2009. And the big driver is the demographics, the 84 million millennials who entered their big peak consumption years in 2018, 2019, really fueling a bull market that could last till 2035. Peak years of consumers consumption for the millennials is the big driver. That's the big picture. From a long-term perspective, a monthly chart of the NASDAQ, I've shared before that, you know, in a super cycle, you can have bear markets. And, you know, we've had multiple bear markets, but still some of the major trend lines are still in place. And even though right now we're going through a correction, given some of these major trend lines, you know, we could come all the way back down on the NASDAQ to approximately the 11,000 level, which is about a 30% correction, and still be within this super cycle bull market. I know people have a lot of concern about rates. 2015 was a period of a lot of rising rates, and growth stocks were in their own stealth bear market, but the market did find its footing and hold the uptrend. So this is a chart of the NASDAQ, a daily chart, and I've just shown some zones on the chart. And, you know, generally I consider a 3 to 5% pullback off the highs, you know, to be considered a pullback. And that's a brief, you know, pullback during an uptrend. And there's really no need for a follow-through day to resume the trend in just a quick pullback. If we get down to the 8 to 12% range, that's really more of an intermediate term correction off the highs. The thing that's noteworthy in an intermediate term correction that there's probably no break of the 200-day moving average, but I would want to see a follow-through day to reset the uptrend coming out of that deep of a correction. A bull market correction, the way I look at it, is a 10% minimum decline, and that's an important and, a close below the 200-day moving average. And I've shown the next two lines are a bear market. It's kind of a standard bear market, is the definition is, you know, 20% off the highs. A major bear market is 25% off the highs and a close below the 200-day moving average, and 2 failed follow-through days within a 3-month period. And I've also put this blue line in here. This is that line of the 11,000 level. That would be a support area to kind of maintain the super bull market thesis. So I wanted to share this. This is actually from LPL Research. This is actually the S&P's performance in midterm election years, which are in the box here. Midterm election years tend to start off kind of slow. You can see in the first quarter and the second quarter, the market is not doing so great, but in the third quarter, things start to turn positive. And after the election, essentially, when the clouds have cleared, the market has tended to rally in midterm election years. Just kind of an interesting factoid. So let's look at the market sentiment and a few internals. Okay, this is a chart of the AAII bull minus bear survey. That's the American Association of Individual Investors survey. And what's noteworthy is we are at a very extreme bearish level in this survey. we've actually reached an extreme level that's even lower than some of the prior readings we had during the COVID low and the bear market of 2018. This is really a measure of retail sentiment. The American Associated individual retail investors, they're extremely bearish at this time. And I apologize that this slide is not as clear as I'd like it to be, but what it does is shows what's the S&P's 500's performance when we get these extreme levels of bears in the AAI survey. So this is the most recent survey where we have almost 53% bears. Just a quick glance, you can do the squint test. You can just do the squint test and you can see 1 month, 3 months, 6 months out, mostly green on this chart. So that's important to know, particularly 3, 6, and 1 year. 1 year is almost always green when you get these oversold, not oversold, but extreme bearishness amongst the retail investor. This is actually a chart of the Ridex funds. One of their funds, which is a totally leveraged bear fund, had one of the biggest spikes in over 10 years. And these are leveraged short and leveraged bearish positions. This is extreme bearishness leverage being put on by some of the institutional funds. This chart here is also with all the talk about rate hikes and the uncertainty of when they're going to be rate hikes and how much the rate hikes are going to be. This just shows from 1983 to today, what has the S&P performance been during rate hike cycles? So these gray shaded boxes are rate hike cycles. And you can see and this is the effective funds rate in blue, the Fed funds rate, and the S&P return. So it's showing you that in this zone when rates were going up, in this particular case, 87 to 89, the S&P returned 44%. So, the S&P, you still can get good stock performance during a rate hike environment. It's how it's done and a lot of other factors. I think I've shown this slide before, which is another, it's another display of rate hikes environments. This is in 2016 through 2018. I mentioned in 2015, the market was very, very choppy. Didn't go, it was almost a stealth bear market, and rate hikes were coming. And you can see this line at the bottom shows these are 1/4 point rate hikes that were occurring throughout 2016 and then 2017. And you'll notice that the anticipation to those rate hikes, there were no hikes going on, but the anticipation, you can see that the NASDAQ corrected 19% and the S&P 15%. Once the rate hikes were in motion, and it was kind of almost expected, and the market understood it, you can see that during that period from 2016 to 2018, the S&P gained 58% and the NASDAQ gained 78%. This is the New York Advanced Decline line on a weekly chart. We really want to see new highs in the index confirmed by the Advanced Decline line. You'll notice that the Advanced Decline line, peaked out in November with the market, and we've talked about that at previous market updates. You can see that the Advanced Decline is still, the chart is showing a declining lower low situation. So the Advanced Decline line is not where we want it to be, though monitoring the last 2 weeks, some of the breadth numbers have been improving. This is new highs minus new lows. I watched this pretty carefully. I always looking at the New York net new highs minus new lows. You'll notice that we finally have started to stay below 200 net new lows for the last couple of weeks, and they've actually shrunk a little further. But there's still work to be done. We'd like to see this get back, to get back to a neutral level while the market tries to recover. There's work to be done, but it's slowly improving. So I wanted to connect a few sentiment things that we just looked at, but I wanted to emphasize that sentiment is a secondary tool, maybe even a tertiary tool. But I also, emphasizing price is number one. That's our number one indicator, and volume is, to me, is number two. Um, but what was interesting in the past week, we've had this follow through day, and we've gotten extreme sentiment readings of bearishness from the AAI, which is retail, and there's a couple different leveraged hedge funds that are very, very bearish right now. We also had a 2-year breakout in the 10-year yields, and we saw a big jump in the 10-year yield today with the inflation report. And we've really had eye-popping negative growth headlines. I mean, PayPal a couple of weeks ago got completely bombed. Facebook was crushed. Snap had a very violent down day and then a violent up day, a lot of volatility, really bad stuff on the growth side. And actually during this last week, the VIX had actually slowly started to decline, saying less fear in the market. Now today that changed. But what the most amazing thing to me is the NASDAQ is still holding the initial low. With all of this incredibly negative and bad news, I would have thought the negative, bad news, this thing would have really broken down. And the fact that it's holding up, I think, is a positive. One of the things that is important in the market is always pay attention to the unexpected. I think Victor and Mike and I were talking, and I said, with all this bad news, what would you expect to have happened? And I go, we probably would have broken the low, and we haven't. So the NASDAQ has stopped going down on lots of bad news. That's a subtle thing that maybe things are stabilizing. Today was not a good day, but you'll also recall we haven't completely broken down. So is it possible we could rally? It's speculation, but it could happen. So the big question is this a bull market correction or a bear market? So I've called up the S&P because I use the S&P when really looking at bull market corrections. So I've taken the S&P chart and put these typical labels that I've used, and I've defined them. And I'll remind you that a bull market correction is a 10% minimum drop from the top and a close below the 200-day moving average, which we got on that major flush down. So here's a few points regarding where we are. There have been 23 bull market corrections in the S&P and 6 major bear markets since 1971, meeting that definition that I just described. The average bull market correction is 13.4%. And the calendar days to reach the low has been about an average of 91 days, a median of about 64 days. The shortest bull market correction was fairly recently, in 2018, between January 26th and February 9th, we dropped 11.8% in 14 days. And coming out of that, it took almost 207 calendar days to actually reach new highs. And if you remember, we had basically had a sharp correction at the beginning of 2018, and we had the bear market at the end of 2018, and the new highs were reached that September. So there about 20% of bull market corrections will lead into a major bear market, and a major bear market being a decline of 40% or more. So today, the S&P has corrected about 12.3%, and it was a pretty sharp correction, sharp decline. It happened in about 20 calendar days. We did have a day 6 follow-through day, which was a 1.9% gain in greater volume. And so far, even with today's volatility, we're still holding the initial low, which is important. We'll have to see how this plays out. We might retest this low. There are 7 examples out of the 23 bull market corrections. There's 7 examples where the first follow-through day was undercut. The low was undercut. and the average is about a 2.4% undercut, and it took about 4 to 16 days to recover that low. So what it would look like on the chart is if we had the initial low of 12.3 in the S&P, if we come all the way back down and actually undercut that low, I'll say 2.4% on average would be considered normal. And if we could recover that low and come back up within 4 to 16 days, that would be a good sign. If we undercut substantially more than that, we might be in for another second leg down in what might become a bear market. So they're just some signposts and things to look at. So I wanted to look at the scenarios, and I did this in my last video where I looked at 3 previous markets. I looked at 2011, 2015, and 1996. Tonight, I really want to focus on 2015 and 1996. The 2015 template was a market that came off sharply, tried to rally, eventually made its way back up to the highs, and then it came all the way back down for a double dip and undercut. The 96 market had a decline, a bull market correction. There was no substantial retest of this low, and we actually came up and we showed a consolidation, which was very, very constructive. There is a scenario for sure of like similar to the 2018 market where we actually come down, we had a rally into the 200-day, and we could break lower in the second wave of a bear market, and maybe usually there's 3 waves down. That's certainly a possibility that's still on the table. So let's take just a quick look at the 2015 market again. It started with a very sharp vertical violation where we knifed right through the 50-day, and we established our initial low. There was a rally, the initial rally, in this case in 2015, it stalled out at the 200-day moving average, and there was a follow-through day that got undercut. But we came back down into the vicinity of the first low, and we retested it, and we actually held. And then there was a sharp rally all the way up into the old area of the highs where this orange zone is showing all the overhead resistance. The market doodled around for a bit and then was just overwhelmed by sellers, and the market really broke again. As I mentioned, eventually undercut the original low. Very scary here, but the market reversed and regained its steam. But it's important to know, we say be patient because it almost took a year before the market reached highs from its previous top. That's a scenario. The second one is 1996. Again, it started with a sharp vertical violation, which is an early clue that we're going to go through a correction. And so we came all the way down to the initial low. In this case, the NASDAQ came off 19% plus. We had an initial rally, as we've had in our market today, and it came back down and it retested the low and it held. And then we got a very strong up thrust with a follow-through day, a second follow-through day, and a third. Very powerful 3 days, which is a really good sign. And the really key to this market was the change. All of a sudden, the market went sideways, digested the gains, and the price volatility calmed down. These ranges are much, much smaller, and we hold the 50-day moving average. And the market actually made its way higher and made a high 4.5 months later, and came back and tested the 50 and then was on its way for a pretty good move. So that's a possibility. Today we're experiencing coming back down. The question is, are we going to retest all the way down to the lows, or are we going to knife through them? One of the things that we're always trying to do is we're trying to understand whether it's stock or the indexes, is there overabundance of supply in the market, or is there demand in the market, accumulation going on in the market? So I shared this chart before. We have growth stocks that are corrected, 50% plus. These are very deep corrections, and we talked about, $100 stock might be cut in half to 50. And we said, as these stocks try to round out, even if they start to make their move up, they're probably going to make a move. And as Can Slim investors, we're looking for a 25% minimum uptrend before the stock builds a base. So when you look at the numbers, if a stock bottomed at 50 and it has an uptrend gets up to roughly around $65, you say it's still way off its highs. And if it forms a flat base of 15% deep, you're not very far off the low. So these things take time. I know everybody wants to jump back into the market, but these things are going to take time, these deep bases. Now, the odds are much better if you can find a stock that's only corrected 20 to 30%, because you can just see that the math just works towards you, coming up 20% at the bottom. Now we're within striking distance of highs. So that's just a much stronger situation to be looking for. Now, what would we be looking for if we said we're trying to find stocks that are trying to build the bottoms of their bases? So I've taken the same diagram and I've just kind of shown the green line as the 10-day EMA, and the magenta line is the 20-day EMA. So what usually happens in these sell-offs, and we've started to see this in some of these growth stocks, you'll get some exhaustion, high volume selling days on the way down. And then what happens is you usually will see some buyers step in. Institutions will step in with some big blue spikes that basically stop the stock from going down. And we'll see these big blue bars. Somebody on the institutional side has decided they're willing to buy the stock. And the stock might start to rally. And the key is it'll rally for a little bit, and then it'll come back down. And the next clue we're looking for is that pullback going to show us that the sellers are truly drying up by having less red volume? So if we can get that, that's a very, very positive sign. And if it can start to hold the 10-day moving average, that's a very early sign that we're building the bottom of bases. Now, to give you an example, here's Datadog. Datadog has come down, and you'll notice some very high volume exhaustion days on the way down. But all of a sudden, we've gotten some institution has stepped in to buy. And you can see they've stopped the stock going down. We got a big reversal at the bottom, and we closed at the peak. And then we got a couple other big blue bars. And you'll notice that this first pullback almost fits my template perfectly, because it pumps right back to the green line, which is the 10-day. And you'll notice that the pullback, the volume starts to dry up. The red volume is drying up, meaning that the sellers are no longer dominating the market. And in this case, you've got blue spikes surrounding that, which is just a really positive sign that the stock is starting to round out the possibility of a base. And we know today that Datadog had a very positive earnings report, and it gapped up. So this is one of the stronger growth names that are currently in the market. But I would emphasize, these are very early signs of the bottoms of bases forming. So some names to keep an eye on, because, we don't, in this case, this is as of yesterday, we said, we don't know if Datadog is going to continue to noodle around and have an extended base building process. We don't know if it's completely going to roll over. And we also didn't know if it was going to gap up today. So these things, we have to be open to, watching them day by day. But there are a number of stocks starting to exhibit these types of characteristics: Bros, Bills, Net, Crowd, Zscaler, NVIDIA, Sedge, Snow. And there's some young names out there as well that are starting to show positive action. And also the travel leisure group. I tweeted out yesterday my thoughts about the travel and leisure group. They've been showing extreme relative strength for the past month. And there's some opportunities, I think, there. But the reality is right now, the cyclicals are currently leading the market. Oil, shippers, fertilizers, and metals are still acting well. Could go either way. We should be watching and observing the bases that are being built every single day. There's no reason to jump in and put your precious capital at stake. But stay engaged with the market and watch these things as they develop into proper bases. So observe the market. Bases take time. Those examples I showed you on the indices, they took 4 to 12 months before they rebuilt themselves to get to new highs. It's important to keep building your watch lists. And patience, patience, patience. This is not a time to be aggressive. This is, right now we are not in a breakout type market. Breakouts have not been working for almost a year, only selectively. And it's really not a time to be aggressive about pyramiding into positions if you're a growth stock investor. And just remember, your portfolio is like a bar of soap. Sometimes the more you touch it, the more it will shrink. So that's my market update. I hope it's helpful, and I'll see you at the next market update. Thanks again.